Hi, everyone who's watching this live or watching it on a recording. It's John Schachter. I'll be starting the meeting in a few minutes. Thanks for your time. Okay, why don't we get started? It's 9:05, so I'm going to share my desktop and welcome everyone to get too many things up. Let me focus on this. Okay, right. And we have a PowerPoint right here. Good. All right, this is the end of the talk. Let's go back to the beginning of the talk and let's go into slideshow. So today I'm going to speak in what is the final talk in the model risk management discussion series. And this is a preview of our upcoming model risk management textbook. So this will probably be the last time I will say this in a talk, but it's basically, it has been a very useful dialogue that we've had about the book with peers. such as yourself, if you're listening to this. There's definitely still time for feedback, but the manuscript is going to start to get submitted in 1 week. So then we're going to focus to some other things called Storm, which I'll talk about later. These are the legal things. This is being recorded. You won't see the Zoom thing that it's being recorded because it's being recorded to YouTube. So YouTube also provides an archive. You may be watching this on an archive basis. Here's the outline of the talk. First, I'm going to do an overview and present myself and the two other authors on the book. I'll talk about how the book can be used, primarily that is in Masters in Financial Engineering course, some of which are called something slightly different, but I'm just going to call them all Masters in Financial Engineering. I'm going to talk about the things that we cover from the standpoint of models and areas of finance. I'll then present about 4 or 5 different insights that we've had. I put one in the preview this morning, and that is barcoding a model for efficiency. Then I'll talk about that, as I said, this is the end of MRMD and what the new thing in this hour will be, and that'll be called Storm. And finally, how to connect. So this first section contains the notable features of the book and a sneak peek of what a printed copy will look like. So this is the first MRM textbook ever. That is, there are books on MRM, but they are not particularly for either self-study or for classroom instructions. They don't have, homework problems. They don't have, Python code in such a way that you could learn all the concepts. There are 20 chapters of the book divided into these 5 areas on the left-hand side. So about equally key concepts, market risk, credit risk, and so on. I'll show you the actual table of contents later, and so therefore it'll be in the slides if you want to page through that. As I said, there's homework problems, there's Python code. We have a grant from publisher Academic Press to produce teaching materials to simplify teaching, and there'll be a companion website which will have the homework problems, code, things like that, ancillary to the book. So here's a sneak peek. This is I'm going to move my image of myself out of the way here. This is what the actual book will look like, the typeset font and so on. And so this is one of the first sections of the book. As we said, there are several books on MRM and model validation, but we have a different view. We really want a practitioner to be able to use this to learn, not just to read about things. And talks a little bit about our background, which I'll cover next. So here we go. This is the 3 of us in alphabetical order by last names. Martin Goldberg is a chemistry PhD with a long history on Wall Street. I want to accent in particular his background working at rating agencies, because we have a full discussion of ratings in the MRM book. That's something that you rarely see in an MRM book. A book would immediately go to things like PD, LGD, and EAD. Martin's had a distinguished career, and one of the first tricky issues he worked on is the non-systematic part of risk. When you look at VAR, we know how to do the market risk VAR, but the individual is harder. Chandrakant Maheshwari is, skip to the bottom, an expert in anti-money laundering, sanctions, and fraud. Has had a distinguished set of certifications, and is in the US, but did his training in India. And I'm Jonathan Schachter, John Schachter. I've been in the field for about 25 years after leaving science. I have had some fun, been fortunate enough to work on some interesting projects on the street. One of them was in 2010 being hired to work out the Lehman bankruptcy. Lehman had about $80 billion worth of assets on its books, but there was no way to price them in order to settle with counterparties because the bank itself didn't have any trading desks because the bank didn't exist. So what we did is we took the September 12th, 2008 prices, those are the last day that Lehman was alive, and we used that as a benchmark, built a model, made sure we understood that model, and then used that model to project the price at the future date that the lawyers were concerned about. I also worked on a large project with similar legal and regulatory scrutiny, which was the London Whale project of JP Morgan. And I can talk about that more if people want to ask me later. So what does the landscape really look like in these master's degree programs? I'm going to call all of them MFE, Masters in Financial Engineering, although they're called, there's a chicken soup of names of them. Some more accenting the math and the quantitative part, and some more accenting the engineering, but they all provide good programs. They're typically 1 to 2 years. I've seen more 1-year programs than 2 years. And you can take some of them part-time. So that would be full-time. You could also do, as I did at Columbia, a part-time program over 2 years. They're also scattered around campuses, and some can have, 3 or 4 programs or something like that. I give examples with NYU and Columbia in a minute. But as you'll see, as I list the programs and the classes that I think MRM are the closest to by the titles of their classes, you can see that MRM, Model Risk Management, does not really appear to be taught in a systematic way. It may be part of a course, it may be mentioned in one lecture of a peripheral course, but certainly there are very few dedicated courses in MRM, and so that the book can fill an important gap. I looked at 20 programs in the US. The first slide is going to be in the New York City area, and the second is going down the QuantNet list of schools that, if they were not already mentioned as being in the New York area, are top schools. And so, yeah, this is you'll see by what I say in a minute what these colors mean. So here's the New York programs. I guess this slide is alphabetical by institution name. So the first one, the Columbia Math and Stats program, is the one that I graduated from. And they do not have an MRM course. They have something called Financial Risk Management, which perhaps could be leveraged so that you could have some lectures about that. And generally you see, as with the pie chart before, that most institutions are in the yellow category. The notable exceptions to be in the green category are NYU and Baruch. So in there, they're really focusing on the models as models, not necessarily as, trying to explain market phenomena, so that you get into the nuts and bolts. I'm holding up my hand, but I don't see it on the screen. There it is. Okay, maybe not. Better not to hold it up. Anyway, I was gesturing with my hand, but they're more specific. So NYU and Baruch win this slide. On the next one, I would say UCLA. The course is not titled Market Risk Management, but I know for a fact, like you can look at their syllabus and see that model risk is one of the risks that they cover. These other ones, oddly, Princeton and Rutgers, maybe it's a New Jersey thing, not to teach model risk management, but there's, I guess they don't have the stomach for that, or for whatever reason. I guess it's a limited number of courses and you can only do what you can do. The the first table in the book, in the first chapter of the book, is a guide for instructors or for people who want to teach themselves. So there's a lot of stuff on this slide. Again, you can see it in the published slides that I'll send later, but it's showing you the titles of the 20 chapters of the book. That's the chapter name column, the numbers of those chapters, and then the idea that, how would you use these courses optimally if you were an instructor or trying to learn something. The titles across the top are a 2-semester course, so essentially using everything. A 1-semester course where you use a part of it, a portion of the course, as we saw like in these risk management classes, and a review for self-study. The subtitle of the book is a textbook for financial engineers, meaning primarily for junior financial engineers. You're either in a dedicated MRM class or you're part of a risk management course, as we said. Now, it could also be used as a reference text, let's say, to refresh those ideas after you've left such a program. It also could be used by other people at the bank that MRM interacts with, as we describe in the book, the model owners and the users, to get a better understanding of how everything works. Let me move this image up. I realize I'm blocking the slide number. I want to have an idea of my pace. Okay, that's a good pace. We mentioned self-study. It's also just, by the coverage, it's with those 20 chapters, you'll see a lot of finance that you may not see in some courses at all, or you may see it scattered in other courses. So there may be an argument for making this, just like a first semester course in every Master's in Financial Engineering curriculum. Okay, let's check. Yeah, that's that. Now, what do we cover? So here's one with the covered instruments. So you can see that we talk about a number of different things. Most of these are pretty obvious. You may have seen before, barrier options on the one hand, path dependent options on the other hand, averaging, things like this. We also talk about quite a lot about credit. This is these may be a little unfamiliar as far as abbreviations. I think most people will know what a credit default swap is. So an asset swap is basically taking an issuer's fixed rate bond and swapping it into float. So you buy a package of a bond and a swap. And the swap rate is chosen so that at initiation, that package is NPV 0. A total rate of return swap is a similar credit vehicle, and that just, you receive all the cash flows, the coupons, and the principal as it's paid out, but you're not actually holding the bond. The total rate of return swaps can be also for equity or for anything that has, intermediate cash flows and then a return of premium, either at maturity or dispersed, like in a advertising situation. There are a lot of models on this page. Again, I don't expect you to read all of them. I highlighted some in red because I think they're probably the most important and the ones that we really devote quite a bit of time on. The forward market model, due to Lyashenko and Brigo, is the extension of the LIBOR market model, but for SOFR, so that we can have a complete model in the sense that we can represent all market instruments, both and relative to the using of risk-free rates, which is SOFR. So with the forward market model, you can price things that compound, meaning look backwards, and you can price things that are term products, so they look forward. And if you don't know what those things mean, the very previous lecture to this, number 27, did an extensive discussion of SOFR and the forward market model. Instead of using the forward measure that's used with zero coupon bonds, it uses something called the extended forward measure. When we talk about CVA, it's a common topic to talk about, but odds are most people will not immediately realize that the limitation on CVA is a situation where wrong way risk would obtain. So often in discussions you see that and they say, well, wrong way risk is basically, the bad kind of correlation for the client, such that like if there are other things go down, it's the equivalent of they're selling you a put, basically. That market goes down and then their margin, capital will go down, and that's a problem. At the same time, but we expand on that. There has been some work done on this. We talk about divide it as though we were doing the capital asset pricing model into general wrong way risk and specific wrong way risk. I just saw a paper that a counterparty's credit or CVA, so their counterparty credit risk, was increasing because of an external factor, namely climate risk, and that would be classified as a general wrong way risk. We talk about large language models large language models in the context of our AI chapter. I talk about other things that we talk about in the AI chapter later, so-called AI bots. But for the moment, it seems to be kind of a wait and see with LLMs. People are using things like small language models. They're using something called RAG. Anyway, we can talk about that some other time. But, I guess my general view of AI, I know I've said this before in one of these talks, it's, as a German colleague said, it's like physics 100 years ago, in the early 20th century, that is, when relativity had come out and quantum mechanics had come out, and people just didn't think that they could be absorbed into classical Newtonian physics. They thought that they were very different things. So I think that's somewhat the tension between artificial intelligence, machine learning on the one hand, and the traditional models were more like Newton. LLMs are more like Einstein, Heisenberg, Schrödinger, and so on. And then just to mention on this page, market risk is often talked about. I just read something the other day about how people are covering market risk at an SRO here in the New York area. But it did not mention reverse stress tests, which are not mandated by the Fed, but probably the most important ones. And they are posterior tests in the sense that you focus on your use case there, if you will, is the bank blowing up, or some part of the bank blowing up, in the sense of losing a business, and then working back to see what are the prior distributions that would give you that. All right, and here's the table of contents. It's 3 pages long. It's relatively small type and smeared a little bit, but to highlight some of the chapters that I know the best, this chapter 4 here, after 3 introductory chapters, is basically synthesizing the methodology, the policies, a lot of the basic things that you've learned, and now putting them in the context of what do things really mean? Like, what is the risk rating of a model? What does replication mean for a model? And it finishes, as you can see, you may be able to see here, with a section on validating the Black-Scholes-Merton model, as a good example, volatility, implied vol, and so on. In this middle section here, you'll see that there are 2 market risk sections, one essentially on VAR and the other one on stress testing, like DFAST and CCAR. There are 3 credit model chapters, one of them on ratings, another one on CVA and PFE, and the third one on, essentially the products that took down the great financial crisis, like instant defaults, credit default swaps, and CDOs, especially bespoke CDOs. And then on this third slide, cover some things that are maybe not always covered in these kinds of textbooks, these kinds of books. For example, operational risk, artificial intelligence risk, model governance, and then just some things that I think it's good to have together, like the discussion of finite sample sizes includes the standard errors for the first 4 central moments, and also for standard deviation, which is a little tricky. I still am upset when I see a result quoted in the financial community with no error bars. And we show that Citi, when they quoted a $12 billion possible one-day loss based on a one-year look back, probably had an error bar of about $2 billion. So, $2 billion on 14 billion, that's pretty large, but there was never any mention of that as being the standard error. Okay, good. So let's talk, these are now insights unique to the book that we have not seen other places. And I guess what they are is they're inviting you to think beyond your math, statistics, and financial models to think about what is realistic. For example, Pearson, or so-called linear correlation, because it comes out of linear regression modeling, is often used. And despite the fact that we know that it's not that robust and probably would be better off in most situations using the more limited assumptions of rank, sometimes called Spearman correlation, or Kendall's tau. But here's an imagining of what would happen if, let's start with 2 normal variables, that is no skew and no excess kurtosis, and the correlation between them is 60% or 0.6. Now imagine, so these variables are x and y, and now on either axis we can imagine what's happening if we then add skewness, right? So a significant skewness starts around 1. You can see by 1.5 or 2 in this, we've gone down to quite a lot smaller values, like 0.55, 0.4, where we started at 0.6. And at very high skews, it's down to 1/3. So the correlation is cut in half. That is what you would measure by a naive Pearson correlation. This is a study that Martin Goldberg did mostly. He tells me that if you do rank or Spearman, you'll be less sensitive to this. But Pearson is still used very, very widely. Another statistical thing is that the things that kill you in a model are usually not the central part of the distribution, but the wings, right? Doesn't look that good in the video, but and so there's something called tonsuring. If you look at this photo of a monk, a medieval monk, you'll see that their style was to cut out the center of their head, in the sense of remove the hair, and only have the hair on the periphery. So that's like the wings of a distribution. So the effect is actually called tonsuring. Tonsure is what that is. An example of this would be to remove 5% of median of distribution, see how it changes results, then maybe move another 5% and so on. And so that's, as I said, by the amount you remove till you get to the wings, that tells you a little bit about how non-normal or non-Gaussian the distribution was to begin with. This comes up in the book in the context of CCAR. Let me first say that CCAR, as described in the book, and as I've talked about in a previous MRMD, is a set of scenarios provided by the Fed on how to do annual tests of, for capital. That is, can the bank really afford to pay a dividend? Can it afford to buy back shares? Or does it really have to hold its capital because some big risk would happen? So, the Fed can't provide everything. So for instance, for currencies, they're only going to be providing currency rates crossed with the US dollar for pounds, euros, and yen. So major current countries. But suppose you have a portfolio then that has the Bulgarian currency, which is BGN. Um, what you might want to do is just see the effect of tonsuring and see, as you remove the center of the distribution and keep the wings, how much do you have to remove? That would be the x-axis here, here. And what is the effect on R squared? So there's an example of how well the linear model works. And you can see that the behavior that you want is at the bottom, which is JPY, which is that by successfully removing the center of the distribution, you get R squared to increase. Let's forget what's happening on the last data points. And so in this area here, now you have a good model that you could do this scenario expansion and proxy Bulgarian currency scenarios to yen scenarios. That's not going to work. It's totally insensitive. This is EUR, and for pounds, it's the wrong direction. Another thing that we see a lot is stationarity. And the typical thing is to test with the augmented Dickey-Fuller and KPSS, I forget what it stands for, but these are two statistical tests that test for stationarity, which is important because that can push you toward being IID, for example, in a VAR calculation. If there's no stationarity, then it can't be IID. Instead, it's the mean is changing, so therefore it can't be identically distributed. Or the variance could be changing as well. So one thing that's not taught in all this is mean reversion, and I think largely not used, where mean reversion actually is a precursor to the ADF test. The ADF test assumes mean reversion, and we'll see that your life is a lot easier if you actually do the mean reversion, the mean reversion test first, so-called Hurst exponent, I'll describe in a minute, and then proceed to the ADF test. Otherwise you get confusing results, as I'll show. So supposing there's a time series of stock prices S sub I, in that case we can take log returns, and then we can look at the how that evolves over time, how the return squared evolves over time is cross covariance, meaning between where we are at t, between a time t and a time t plus tau. This is reflecting that this is assumed to be a weakly stationary series, so we can focus on just the first and second moments. It's a little skew in kurtosis. Anyway, so basically that cross covariance goes like something tau to the something. By convention, it's 2 times h, the h exponent. So that if it's 1, which would be the case for Brownian motion, then h equals a half. That's this case. The other two cases are less than or greater than a half. In the case of geometric Brownian motion, we know that that's not a mean reverting process, it's stochastic. But here, it turns out that on the other two possibilities, you can say something. If h is less than a half, then the series is mean reverting. If it's greater than a half, then it's not mean reverting and there's a trend in it. So that could be like a level, that it's going increasing over time, which is a problem and will make it non-stationary. So how do you use mean reversion in this together? As stated, ADF assumes mean reversion to the extent that the alternative hypothesis in ADF is either full stationarity or trend stationarity, but you cannot tell the difference between them unless you check whether it has a trend, right? So then what you need to do then is compute h first, and if h is greater than 0.5, as I said in the table, then it has a trend. So then you could fit a line to it and remove that trend and retest. In that case, you would know the difference between the ADF, whether it's fully stationary or not. You could rule out trend stationarity. Now, I don't see this a lot. What I see instead is people just blindly run ADF and KPSS. Well, then you can have a situation where one of them will fail and the other one will pass. So I already explained what will happen with ADF, that, it will fail if there's a trend. With KPSS, it's the opposite, and there's something called different stationary. Uh, right. So, you'd like to have everything pass. So then by all means, eliminate the mean stationarity, the mean reversion, if there is something. Another topic that I talked about this extensively in a MRMD devoted to Monte Carlo. One sec. Is the idea of two-dimensional convergence, or what I call seed variance. So this is a fictitious convergence of something to 10,000 by parameterized by the number of realizations, the number of simulations. It's on the x-axis and the price. So if everything were smooth, everything would be 10,000. This is where it's supposed to converge to. The green noise is because you have, that n is finite, the number of realizations. But the error bars are because what we're doing is we're averaging over the results from a number of different seeds each time. The right seed, I have a bullet up here to remind me. So, every pseudorandom number starts with a seed, and that's useful because you can start sequences and make sure you're using the same thing. But on the other hand, it means that if you go to the regulator or senior management and you give them a number and it was from one particular seed, so that's the right seed. If you did it from 10 different seeds, you could get 10 different numbers. And then what do? Which is the right one? Right. So my simple solution to that is just to average. And in fact, you can look at the standard deviation of the seeds, and that's a measure of what I call seed variance. So the seed variance is getting smaller and smaller as the number of realizations increases, but the number of seeds is the same. Let's talk a little bit about AI. I'd say I have about another 5 or 10 minutes, and then I can pause and see if chat for questions, or just shoot from, what is it? Shoot from the heel, shoot from the, anyway, I can certainly fill up 10 minutes, particularly if I have a bit more espresso. So AI is a multidimensional thing. I guess that's what I would say. I'm going to talk about bots here, but there are at least two other ways that we talk about in the book. One of them is using AI to replace existing pricing and risk models. And yet another way is, understanding the way that regulators use AI and understanding the way that regulators think that banks should be using AI. There's nothing in the SR 11.7 document that talks about it. And there's some problems. I mean, especially if you look at the SR 11.7 section on inventory. Think about what inventory means for an AI model just for a second. I will get to the material on this slide. If your aim in inventory is to be able to do things like repeat a model or get sensitivities to a model or things like that, those are tough challenges. For AI, you use a training set. Did you use 30% that day for the test portion? Did you use 50%? So all these things, and the data themselves would have to be preserved in inventory if you want to be able to repeat. And any metadata and other parameter choices. So those two issues can do themselves. AI bots is probably the easiest one to implement and the easiest to describe. So bot, if you didn't know, comes from the Czech word for worker. It's a common root in Slavic languages. If you want to say, I work at JP Morgan, you would say, ja, I robotaju. See, there's the word robot, robotaju v JP Morgan. I work at. So it just means work. It's the Czech playwright used it for a play where robots take over the world. That's not such a good thing. But anyway, so a bot is, just something like the difference between Google Maps and having to fan fold a piece of paper. I mean, it's something that does things systematically. It can search for traffic changes, things like that. So it's the automation of these processes. Let's even go back to the assembly line of Henry Ford in Detroit. The idea that you can simplify things by doing them systematically, and in our case, by having them done digitally. So, for example, one of the most tedious things that I've seen in model risk management is that someone needs to go through this gigantic inventory and figure out what are the next models to be revalidated, let's say in the next month or two. And so that's just paging through spreadsheets, which I don't know about you, but that's my least favorite thing in the world to do. And there are always human errors. You overlook things. So that would be a good application of AI bots. Another one would be when you write a model review report, you may have requirements and recommendations on the developers, on the model owners as well. And so when you go to review it, so the bot could be up there and it could capture the date on which those recommendations or requirements were met and how they were met. It can also extract text from the model developer document. And, there's also can be a lot of limitations set on models. Limited trading authority, for instance. I'll talk about that in a little bit. It's also, could be used for op risk, like finding a bad trade, right? A fat finger error. Looking at everybody's schedules at the company and realizing that everybody's going to be on the same plane, on a very dangerous route to Central America. So key person risk. Next up, I want to talk about is a little bit revolutionary, and it's put forward by my colleague, John Hill, my former boss, John Hill, who's an adjunct in the NYU Engineering School in its Master's in Financial Engineering program. So he teaches model risk. And some of his own research has been about what giving models a name. So basically the situation, it's a good news, bad news. So good news is that models have serial numbers, names, things like this, but nothing is really done with them except for in a manual manner. So you can make a list and, there can be an Excel column in it, but nobody knows, but the model itself doesn't know its own name. That's what John Hill's paper is about. So let's make this more systematic. We remember groceries before barcodes. We remember tolls before Easy Pass technology and transponders. So let's set up a system so that a model can spit out its name, and then when it's run, we could include a whole bunch of other things with that. For example, the currency, the notional, when it was run, so on and so forth. What else do I say down here? Yeah, the model version number, that's important. And even specifically the MAC address where it is, so then you can tell who ran it, basically. But it would be like scanning groceries or like scanning your car at Easy Pass with transponders. Why do we do this? Well, oftentimes, as Professor Hill says, regulators will come to a company and they'll say, what models do you use the most? And the bank has no idea because they don't have anything like this kind of barcode. They can just tell from talking to people and anecdotally figuring it out. But, the great financial crisis, as I talked about when I spoke about correlated credit risk, if you had had a system like this, you would have seen that nearly everyone is dependent on the Gaussian copula model. And so, that's bad. We tell people don't invest all your eggs in one basket, have a diversified portfolio. Well, maybe there's a kind of abstract diversification in the sense that banks should be using multiple models and not putting all their eggs in the same model, right? So that's an important thing. Um, there's a lot of manual affirmation out there where you have to get, people have to answer something in an email or they have to check off boxes in an Excel. You can figure out whether things have gotten done just by tracking that model ID. And what I started to say a slide ago, if you look at the last bullet on this, is that models have limitations. So it could be that you can only trade this with, uh, vanilla swaps. So if there's a cancelable swap, you can't use that on the model. So that would be, the model is limited. LTA means limited trading authority. So then you go in and you see with the barcode that yesterday somebody tried to use this on a cancelable swap. Well, that's not a good thing because people are not following the rules. There might also be notional limits or that it's only allowed for certain circumstances. A big one based on the SOFR talk is that banks should not be, they can produce term SOFR products, but they should not be initiating them. They should not be creating term SOFR swaps because of what's called the inverse pyramid problem. So that could also be something that could be checked with this. All right, so that's the end of the content of this talk from the standpoint of what the textbook is. As I mentioned, the expected publication date is January of 2026, I guess a little more than a year from now. And we are in the process of submitting the final versions of the manuscript. We're doing the text first, and then we're going to add the homework problem. We have a number of homework problems, but we need to expand that and mount them on the FTP site and so on. So that's the end of, now I finished the last of these 6 months of model risk management discussions. In this slot next week will be another 1 hour talk, but it'll be on what I call special topics of risk management, just to have a nice acronym, STORM. So the first storm will be December 4th, a week from today at 9 a.m. Eastern, 2 p.m. London, on securities lending. And that, as this will be a Zoom, and it'll also be live on YouTube, and YouTube will archive for future replay. Let's talk a little bit about this. What is securities lending? Well, it began when people just couldn't settle trades easily. So that, if the seller is promised to provide shares, or the intermediary from the seller, then he could deliver to the buyer, but he would have to borrow them from a third party and then pay a rate to do that. So there is a cost associated with borrowing anything, cash, but also securities. How that's computed is, we'll talk about further. But what that has become in modern times is giving you the ability to do short sales. That's the most important thing. From the short seller's perspective, you don't own the shares, you don't have a long position in the shares, right? You do not want the shares, you're bearish. So what you have to do is you have to go out and borrow them and then sell them, the textbooks say immediately. You have to sell them so that you can buy them back at a lower price if, as you expect, the market goes down. Such transactions are also necessary for some repos. And in fact, there's a whole literature on, that there's sort of lists of stocks. There's easy to borrow, locate to borrow, and hard to borrow, telling you about essentially the liquidity in the short market. The easy to borrow, almost certainly that would include things like Google. Well, I don't know. Actually, I shouldn't say. These things are not made public. And on the right, I talk about some recent research papers. For example, mutual funds are big securities lenders, but there may be some things that at the outset sort of look like anti-competitive practices. There's a recent paper on the way the German mutual funds work, that they may kind of, goose up their portfolios by the way that they lend. The principal beneficiaries of this are mutual funds like and asset managers like BlackRock. That is, they have all these securities, so why don't you make money on some of them by lending them out? The risk, of course, is that the counterparty will fail to pay margin and fail to return the shares to you. Custodial banks, this is also big for, especially Bank of New York and State Street. And then I've also seen this on the private bank side, that there are wealthy individuals who have stock and want to make money on it. And as you can see, this blends market risk and counterparty credit risk elements. So this then will be the first talk in Storm. I also created a Storm LinkedIn group. I guess you have to type in special topics of risk management. But here's a link to it. And in many cases, if you request, you don't even have to request to join. If you just say join, it will look at your profile and see if it makes sense for you to join automatically. Otherwise, it'll contact me and I can approve you manually. Now just a little bit about me. I'm a consultant. My company is Delta Vega Incorporated. I have a number of different businesses. One of them is executive risk training, such as the talks I've been giving here, just training in general. I have a long history, about 25 years of quant work in model validation, in market risk and in credit risk. And I provide expert witness services to litigation. I'm also teaching financial engineering. Well, that's what I'm doing right now, and would consider an adjunct in an MFE program. I'm also happy to talk about how my business works and how you set something like this up in the US, specifically in New York State. So then quickly, here's the contact information for the Zoom. And this would be for the new talks on Storm. This is not the same link as you're on now. In the case of MRMD, I have a network drive on Dropbox, which has the slides and so on. So I'll set the same thing up for Storm. I just don't have any media for that yet, so I haven't populated it yet. And I'll disclose that in the talk next week. Finally, here's my contact information, and that's it. I'm going to then stop the share and see if there are people who have questions. I don't see anyone else on the Zoom right now. Let me go back over to the YouTube, and we'll see if people are on that. That'll be a little bit delayed. Let's see, where were we? Scroll down too far. I see 2 people are on, so let me say, oh, here's the panel. Oops. The fingers seem to be moving all over the place. So I'll just say, any questions from YouTube audience? Please put in chat. And you're welcome also to, you can't see the screen, but I can. Sorry, I forgot about that. Let's just see if people come through on that. These are archived. I'll just leave that up just for the last, we have 4 minutes left on the top of the hour. And the YouTube's somewhat delayed. Looks like by about 3 or 4 minutes. Okay, so just to say, this is the day before Thanksgiving, the big American holiday. Canada has a Thanksgiving too, but it's more in the center of the fall, like October. And in fact, that's probably more closer to what it really is when the Pilgrims were there in Massachusetts. There are a lot of course, different ways to look at Thanksgiving. It is like Columbus Day, a celebration of, a lot of bad things that the colonists did. Kill the Indians by infecting them and by shooting them and so on and so forth. So there's nothing happy about that. As a harvest festival itself, I think it comes because the Pilgrims were deeply religious and they knew that there's a fall festival celebration in Judaism among the ancient Hebrews and continue to this day of a harvest festival, Sukkot or Sukkot, that some of you may know about. But that doesn't happen in November. That's why I'm saying that would be a lot more appropriate to be in October as the Canadians do it. But that's basically what we're celebrating here. I would say it's just a big family holiday. And if you're familiar with kind of the craziness of Asian Lunar New Year, at least what we hear in this country, is people, the trains are packed. And it's crazy because everybody has to get home by that. Well, that's the equivalent of what's happened in the United States on the day before Thanksgiving, because Thanksgiving, is tomorrow. So in theory, you want to be sleeping at your parents' home or friend's home or wherever it is you're doing Thanksgiving by midnight tonight, if not earlier. And the date can't be moved. It's also a Thursday, and then some people work on Friday, which causes infinite confusion. And I got a parking ticket because I thought the day after Thanksgiving was a holiday, but it's not in some jurisdictions, one of them being New York City as far as parking. And then people sort of drift back on the weekend. It's not symmetric that Sunday, the end of the weekend, is not the busiest travel day of the year. Today is the busiest. But I'll be sitting at home and cooking. And I hope you can celebrate where you are. If you're not familiar, the U.S. basically was shut down on Thursday and Friday with limited staff on Friday. So if you haven't reached someone by this time today, or by noon today, say, you may be better off just waiting until Monday. All right, so happy Thanksgiving. I hope to see you all in the new iteration of this on Wednesday the 4th, which will be on SEC lending, securities lending. Take care. We're just up at 10 o'clock.